At this point in our study of financial accounting, we've seen balance sheets and income statements and statements of cash flow. But what I want to do now is I want to take a more granular look at particularly the balance sheet and the income statement as it relates to merchandising businesses. Now, what differentiates merchandisers from a lot of different other types of industries is this necessary evil called inventory. And I do refer to it as a necessary evil. Most businesses that maintain inventory would prefer not to do that if there was any alternative. Think about it. There's a lot of problems associated with inventory. You have to purchase it. You have to store it. At the end of the month or the year, you probably have to count it. You have to make sure that there's enough on hand. There's always a risk that it gets stolen, or maybe if it's perishable, like food products, it could get spoiled, or it could simply become obsolete. Remember the selfie stick? I don't think anybody wants to have a large inventory of selfie sticks today. So we have to have inventory, even though it's this necessary evil, because when you go into Best Buy or whatever retailer and you're looking to purchase a particular product, you want to be able to walk out of the store with that item. Or even if you're clicking Amazon or whatever, you still want to be able to have that item available when you need it. And the retailers know this. So we have to deal with inventory. Now, we need to talk about a couple of fundamental broad categories of costs. Product costs are going to be included in our inventory. Sometimes we'll call these inventoriable costs for that reason. Now, what's going to happen, and we're going to see this in a few minutes, is that the product costs will initially land on the balance sheet when a company makes these purchases. And those costs will stay on the balance sheet until they get released to the income statement in the form of an expense called cost of goods sold. Now, non-inventoriable costs, sometimes called period costs, are things like selling general administrative costs. What differentiates a product cost from a period cost is that the period costs go directly to the income statement. Oh, sure, they might stop in a prepaid account or they might be tied up into a deferred type of account for a little while or an accrued account. But these costs, absent any timing differences on the balance sheet, they don't go through inventory. They go directly to the income statement. Now, let's take a look at what's happening here. At the very bottom, I want you to take a look at this beginning inventory balance. So we start the period, whether that's the month or the year, with a certain quantity of things on hand. And then obviously most businesses during the period will purchase some additional quantities of inventory. If you take these and just combine your beginning inventory with whatever you purchased during that period, that is the most you could sell. That is your cost of goods available for sale. We can measure this in terms of the number of things. We can also measure it in terms of dollars. Now, what I want you to think about is this. If we take this cost of goods available for sale, okay, and let's bring it on up here and think about what could happen with not only these items, but also with the dollars. Really, two things can happen. Cost of goods available for sale can stay on the balance sheet in the form of inventory, or can be released to the income statement in the form of cost of goods sold, which is essentially an expense on the income statement. What we have here is the matching principle and the revenue recognition principle coming into play. The cost of goods sold will only be recognized when we sell the products and we recognize the related revenue on the income statement. So very broadly, I think it's helpful to think about it this way. You have cost of goods available for sale, and it's either going to be things or dollars. There's really only two options. They can stay in inventory, or they can be released to the income statement as cost of goods sold. If they stay in inventory, that's going to be an asset that's recorded on the balance sheet. If it's cost of goods sold, that's really an expense that gets reported on the income statement. So when we sell merchandise, we recognize the revenue on the income statement. That's the good thing because we're earning revenue. And then we also simultaneously recognize the cost of goods sold. Because under the matching principle, what we want to do on the same income statement where we list the revenue we earned, we also want to list the related cost of goods sold. So ultimately what happens is when the merchandiser purchases merchandise for resale, it starts out in inventory and it'll stay in inventory until they sell it. That's when the dollars get moved over to the income statement as cost of goods sold. And ultimately, sales revenue minus cost of goods sold will give us our gross margin, sometimes called gross profit. So one of the questions you might have is, how did the companies track this inventory? How do they know when inventory is leaving the balance sheet, going to the income statement? And in a future discussion, we're going to talk about some methods for measuring or approximating ending inventory and cost of goods sold. We'll be talking about things like FIFO, LIFO, weighted average, specific identification. But for now, let's just focus on a couple of broader concepts, and that's perpetual versus periodic. Now, we'll talk about periodic at the very end of our discussion, because the reality is a lot of companies use the perpetual method. There are a couple of big advantages, okay? Inventory is adjusted perpetually or continually throughout the accounting period. So pretend you're an electronics retailer. When you receive a shipment of televisions or smartphones or whatever in the back door, you're going to increase your inventory account immediately, quantities and on the balance sheet. And then as you sell those electronics to your customers, you're going to decrease your inventory, quantity, and the dollars on the balance sheet. And you're going to, in pretty much a real-time fashion, at least throughout the month or throughout the year, you're going to recognize the cost of goods sold immediately. Now, perpetual inventory certainly has these advantages that we can update the inventory balance in a real-time fashion, and we can immediately measure our cost of goods sold. But it comes at a cost. We have to invest in the infrastructure, the technology, the software that we would need to be able to track inventory in such a real-time manner. So there's always going to be a cost-benefit consideration to any decision that a business makes. If the benefit outweighs the costs, then we probably will do something. If the costs outweigh the benefits, we really have to think hard about whether or not we should adopt a particular strategy or choose to do something a certain way, even if it seems like it's beneficial. So we always have to kind of consider this trade-off. So what I'd like to do is take a look at how certain transactions involving the merchandising business would affect certain elements of the financial statements. If we take a look at this first transaction, the company is purchasing merchandise inventory for cash. Okay, so your textbook would call that an asset exchange transaction because you're trading one asset, cash, for another asset, inventory. And what you can see here is the remainder of the accounting equation is unaffected over here. Nothing's happening on the income statement yet because we didn't sell that inventory. It is sitting on the shelves. It's waiting to be sold. We're not going to sell that. We're not going to move those dollars from the inventory on the balance sheet to the expense on the income statement until we actually sell them. Now, that did require cash flow. So keep in mind that that is an operating activity. Because we used cash to purchase that inventory, that will be recorded on the statement of cash flows, which explains one of the differences between accrual basis net income and what's happening in the company's checkbook. Now, this might seem like it's a similar or exact kind of scenario, but the difference is this. The merchandise inventory was purchased on account. So now there's going to be no effect on the statement of cash flows. Nothing happening here because we didn't pay for that inventory yet. We still have inventory increasing by $11,000, but we don't have cash decreasing by any amount. Instead, this is an asset source transaction. In other words, we acquired assets without using other assets at this point. Our vendor extended credit to us. So this accounts payable is a current liability that will be reported on the balance sheet. And because it's a current liability, we know that that liability will be satisfied very soon, probably within the next month or two, realistically, because if you don't pay for that particular purchase, eventually the vendor will stop sending things to you. So now let's sell this merchandise. What we see here, we've sold merchandise to our customer, so they give us cash, wonderful thing, asset increases. And where is that coming from? It's coming from the sales revenue we earn from our customer. And what I'd like you to consider is that all other things being equal, an increase in revenue will ultimately cause an increase in the net income of the company for that particular period. And sometimes this is a bit of confusion for students, but what we can see also is that when net income rises, retained earnings also goes up. Now, it's not going to increase probably until we close the income accounts and the expense accounts at the end of a particular period, but ultimately that is the effect. If customers give you money and you earn that revenue, then net income goes up and retained earnings will ultimately go up. Now, you can still earn the revenue if the customers did not pay you yet, as long as you believe that collection is probable and you can measure the amount that you expect to collect. You certainly could have an alternative called accounts receivable. Now, if your customer promised to pay you in the near future, you wouldn't have an operating cash flow, so nothing positive happening there, but you would still recognize the revenue. Now, remember the matching principle. So since we are recording the revenue, which is a good thing, it makes our net income bigger, we also need to capture the related expenses. We need to match the expenses in the same time period as the revenues that were generated as a result of those expenses. So now we have an asset use transaction. Remember this kind of fundamental concept that cost of goods available for sale can either remain in inventory or it can become cost of goods sold on the income statement. What you're seeing here is that the inventory in this case is decreasing by $8,000, and cost of goods sold, which is an expense, is increasing by $8,000. The result of that is that our net income declines by $8,000, and ultimately our retained earnings will also decrease by $8,000. But that makes sense. We sold the items and earned $12,000 of revenue, and if those items that we sold had originally cost us $8,000, then we should recognize only the $4,000 of gross profit related to that particular sale. These two transactions that I have listed right here don't necessarily apply only to merchandisers. You could see either one of these transactions in a service business or any other type of entity or industry. But I wanted to include them just so that we could distinguish product expenses from period expenses, because these are, well, this first one is really a period expense. Remember that the period expenses are non-inventoriable. So what that means is that this is not going to originally be included in inventory. It's not going to become part of that cost of goods available for sale that we've been dealing with. Instead, they're going to go directly to the income statement. So we pay $1,000 for some selling expenses. Maybe that is we paid for an advertisement. Maybe we boosted some posts on Facebook or Twitter or something like that. But either way, we spend the money. We incur an expense called advertising expense. So our expenses rise, and ultimately our retained earnings goes down pretty much immediately. Like I mentioned, you might have a prepaid expense or an accrued expense that could cause a little timing difference, but don't confuse that with inventoriable costs. These dollars will not go through the balance sheet in the inventory account. They are destined for the income statement as soon as it's the appropriate time for them to be there. Just as a little reminder, over on the statement of cash flows, this is an outflow for operating activities because we are spending money. Now, down here, this is neither a period nor a product cost. This is really a capital asset that we're purchasing. So something that has potentially a long-term time frame. So the company may want to build another store. They find an amazing deal on land for $5,500. They spend the money and they get a different asset called land. So really what they're doing here, they're taking a current asset and they're turning it into a long-term asset. This is actually a transaction that reduces the company's liquidity because we're taking a liquid asset and turning it into something that may not be as easy to sell, or at a minimum, we don't have the intent to sell that. Now, on the statement of cash flows, that is still using money. So even though this doesn't impact the income statement anywhere, it's not a current expense. What it does do is it shows up in the statement of cash flows in the investing section as cash leaving the entity. One of the problems with inventory is shrinkage. Now, what shrinkage is when we lose inventory and it didn't go out in the hands of the customers. Could be theft, could be spoilage, could be obsolescence. Let's take a look at this right here. Now, we've got a little analysis of our inventory. So the beginning balance of inventory was $6,000. And then we add to that purchases. Now, it's possible that we returned some of those purchases. Maybe it was defective merchandise, maybe it's something we didn't need. But those purchase returns will reduce our cost of goods available for sale. It's also possible that we earned a discount from our vendors. Maybe for prompt payment, they let us take 1% or 2% off of what we owed them, so that reduces the cost of what we had to purchase. Of course, there's transportation in. Think about the last time that you purchased something online. If you're not a member of Amazon Prime, you probably had to pay some shipping charges to obtain that merchandise. So not unlike what you would do online, businesses, when they have to obtain inventory, they may have to pay a freight fee or something to a trucking company to get that merchandise to the location where it needs to be. So when we add this beginning inventory plus, really, I would put these here and call them net purchases. So it's all of your purchases, net of any discounts, and including any transportation in. So you've got your cost of goods available for sale. Well, remember our little triangle here. Cost of goods available for sale can be inventory, can be cost of goods sold. So if our cost of goods available for sale is $16,100 and the ending balance in inventory is $4,600, that must mean that our cost of goods sold is $11,500. So the balance sheet has $4,600, the income statement has $11,500. But we've got a little problem here. We actually counted what we have on hand, which is very common at the end of a month or a year. Businesses will take a physical inventory count, and we didn't have $4,600 in the back room, on the shelves, wherever we're keeping this inventory. We had $4,100 worth. Now, I don't know where the extra $500 went, but the reality, guys, is that our cost of goods sold is really $12,000. $12,000 becomes an expense on the income statement. $4,100 remains on the balance sheet because that's really what we own as of the balance sheet date. So this $500 is something referred to as, we can see there, shrinkage. It is an expense because it represents inventory that we lost. Now, the perpetual method that we've been talking about somewhat allows us to measure our shrinkage in a real-time manner. It may not be able to identify exactly why there was shrinkage. We may have to rely on other controls to determine whether it was theft or spoilage or breakage or something like that. But at least we can measure it in a real-time manner. One of the disadvantages of the periodic system that we're going to talk about at the very end of our discussion is we have no way to specifically measure shrinkage. In fact, we may be oblivious to the fact that shrinkage exists. This particular type of transaction is not something that's exclusive to merchandisers. This could happen in any company, in any industry. But I think it's interesting to take a brief look at how this transaction affects the income statement differently from the balance sheet, and how it's even unique on the statement of cash flows. So remember that piece of land that the company purchased, and they thought they were going to build a new store location. Well, guess what? They changed their mind. And for whatever reason, they're not going to build the store there. So they sell the land, and they receive $6,200 worth of cash. So cash asset increases on the balance sheet. What's going away is the land. Now, the original cost, we would call the basis for this land, was $5,500. So what we see here is that the asset called land decreases. Okay? So this asset's going away, and not a very difficult concept here. If you sell something for more than its original purchase price, you're going to recognize a gain. The company is better off because it purchased this land for $5,500 and later on sold it for $6,200. So on the income statement, that's going to increase our company's net income. It behaves kind of like a revenue in that it increases the profitability of the company, but it's not a transaction that involved our customers. We're simply selling a capital asset. But a gain is a gain, and it will make retained earnings get bigger on our balance sheet, which makes sense because our net assets increased by $700. Cash went up by $6,200. Land went down by $5,500. Overall, the assets increased by $700. So the shareholders' equity should also increase by $700. On the statement of cash flow, the full $6,200 is an investing inflow in the investing section. So it's a source of cash. And you want to make that differentiation between this little bit of gain that's being recorded on the income statement under the accrual basis of accounting and the actual cash that's being reported on the statement of cash flows. So some of these transactions we've been looking at, let's see how they show up in the income statement. So June's Plant Shop, we've identified the name of the entity. Don't forget to call it an income statement. Unless there's a net loss, then you would call it a statement of operations. We don't want to be liars and say that there's an income if it's really a loss. But the most important thing here is to understand that this covers a period of time. In this case, January through December of 2019. Now remember that cost of goods sold that we measured after the shrinkage? It's right over here. There's that $12,000. So sales revenue minus cost of goods sold gives us this gross profit or gross margin, which is our first step toward having an overall profitable company. These costs, these dollars and this $12,000 here, originally were on the balance sheet, and then they were released to the income statement when we generated sales revenue. Now, remember the advertising we had and maybe some other selling expenses like transportation out, in other words, transportation for selling products to our customers. Those simply arrive on the income statement without going through the balance sheet. So these dollars right here never touched the balance sheet. We get down to a number called operating income. That is supposed to measure the results of operating our company, the core business of the company. Now, certainly, sometimes we might have some interest expense because we borrowed money from a bank, or we might even earn interest revenue if we happen to loan money to an entity. We also have things like, remember that land that we sold, the $700? That doesn't show up in the gross profit. It doesn't even show up in operating income. Because think about it this way. We're not in the business of selling land. We're a plant shop. So if we happen to sell a piece of land and it happened to generate a profit, well, sure, we'll take this wonderful boost to the bottom line, but we should not include that in operating income because it's not going to be replicated in future years, most likely. Keep this in mind. Fundamentals for financial statements. Financial statements should allow us to assess future cash flows. And they should answer three fundamental questions. How much? When? And then finally, how likely? Now, I'm not suggesting that as financial accountants we have a crystal ball, and we certainly don't. But you can see here, if we have some cash flows or some revenue being generated simply because we have a gain one time, that's telling us, you know what, we know how much it was, and it's also telling us that in the future that's probably not likely to happen again. Or if it does, we don't exactly know when that's going to happen. So we kind of keep that in mind. One of the things we can do when we are analyzing financial statements is we can express them in terms of what's called a common size analysis. Take a look at June's Plant Shop here. 2018, our sales revenue was $12,000. And in 2019, revenue more than doubled to $24,750. How can you compare the performance of 2 years when one of those years has more than double the activity of the other? Well, one of the tools we have is what's called a common size. So what you can do is you can express everything as a percentage of sales revenue. For example, this $3,000 of net income divided by $12,000 of our sales revenue is 25%. 3,000 divided by 12,000 is 25%. And if we go over here, that same concept of net income, the 7640, divided by the sales revenue for the new year is 30.9%. So what that's telling you is not only did June grow her business, no pun intended, but she also grew it more profitably. She controlled her costs. For every dollar of revenue in 2018, she earned a quarter. For every dollar of revenue in 2019, she earned nearly 31 cents. So this common size financial, expressing items on the income statement as a percentage of revenues, is useful for comparing the financial performance of one entity across multiple periods of time. It's also useful if you're comparing different entities of different sizes. For example, if you wanted to compare Lowe's with Menards with Home Depot, a common size financial statement could be a very useful tool. So we've talked mostly about the perpetual inventory system, but there are businesses that still use the periodic system. And just keep in mind the cost-benefit rule. As I'm recording this video right now, I'm not too far removed from Halloween when I went to the pumpkin patch and I got a pumpkin with my family. And I can pretty much guarantee you that that pumpkin patch should not be using perpetual inventory. It doesn't make sense for them. The benefit that they might obtain does not even come close to the cost that would be involved with having a perpetual inventory system. So it's okay to have periodic inventory systems if the cost benefit does not exist. But there are disadvantages. There's less control of inventory. You can't really quantify your shrink as well, even though it is simple and it is efficient. Now, one of the things to think about is this. With a periodic inventory system, you are not perpetually or continually updating the inventory on the balance sheet and releasing it to the income statement as cost of goods sold. You will need to take a physical inventory at the end of the year or at the end of the period. Now, cost of goods available for sale is still going to be the $16,100 that we dealt with a few minutes ago. And the ending inventory is still going to be the $4,100 that we have right here that we had measured before when we counted our inventory. But what you'll see is this cost of goods sold of $12,000, we don't know that there was $500 of shrinkage. It exists. It's being measured in the cost of goods sold, but it's not staring us in the face like it was when we used the perpetual inventory system. Cost benefit though. So at the end of the day, the periodic inventory system may make sense for some businesses if the benefit of perpetual does not exceed the costs of having the infrastructure and the capabilities for measuring that inventory.